Applied Materials is navigating one of the most challenging environments in years.
60,000 factories in our country closed, shuttered, gone.
Geopolitical tensions and US export curbs are shaking up the global semiconductor supply chain, cutting hundreds of millions from China sales alone. With rising trade war risks, the company growth path could face serious disruption. In this video, we will look at Applied Materials economics and do a deep dive into the raw numbers. We'll analyze the financials to see how they're holding up, including revenue, EPS, debt, and dividends. I'll also do a deep dive into the economic moat of the company, highlighting its strengths and weaknesses. Lastly, we'll sum this all up into a total score for the company, looking at both the financials, the moat, and the general business model. Income statement. So Applied Materials revenue has grown steadily over the past decade, climbing from about 11 billion in 2016 to over 28 billion projected for 2025. Gross profit and net income have followed, though earnings growth is slightly lower than revenue. Forecast points to a 7% rise in revenue and 8% in net income, showing improving profitability. Both top-line and bottom-line growth signal strong fundamentals for investors. Looking at growth trends, we see strong surges in 2017 and 2021, both above 30%, while 2019 dipped. Since 2023, growth has cooled to single digits, with the trend line showing a slower pace. The bright spot is net margin, rising from roughly 16% to over 24%, reflecting better operational efficiency and steady profitability despite the softer revenue growth. Semiconductor systems drove over 73% of revenue, mainly from equipment used in chip manufacturing. Applied Global Services contributes 23%, focused on maintenance and tool upgrades. Display adds just over 3%, covering technologies for screens and panels. With 12.9 billion in gross profit and a disciplined spending, net income stands at 7.2 billion, or about 26% of total revenue. Here we see revenue by geography over the past 5 years. Taiwan and China remains the largest markets, though China's share has slightly decreased recently. The US and Korea have been relatively stable, while Europe and Japan contribute smaller but steady portions. There's a clear geopolitical risk here. US exports restrictions on advanced chip equipment have already impacted sales by roughly $400 million in 2025. With ongoing tensions, particularly around China, this regional dependence could pose challenges if trade barriers tighten further. Recent developments highlight these risks even more. Recently, Applied Materials reported revenue of 7.1 billion, up 7% year-over-year, but China sales dropped sharply to 1.77 billion, marking the third straight quarter of decline. With trade tensions escalating and Trump's new policies threatening to tighten controls even further, Applied access to one of its largest markets could be at serious risk. If the trade war deepens, we could see slower revenue growth, margin pressure, and disrupted supply chains. While net income still improved to 1.94 billion this quarter, the outlook could darken quickly if these geopolitical headwinds persists. Comparing revenue growth with peers, Applied Materials revenue rose about 73% over the past 5 years. That's ahead of Tokyo Electron, but behind KLA, which grew nearly 95%. This performance shows Applied Materials is competitive, though not the fastest growing player in the industry. In terms of EPS growth, Applied Materials is up 139% over the same period, outperforming Lam Research and Tokyo Electron, but once again, trailing KLA's explosive 234% growth. Let's look at what protects Applied's position, its economic moat. A moat is an advantage that protects a company's market share against competitors. Applied Materials scores particularly well on switching costs and economies of scale, both rated as wide. The company's manufacturing processes and ecosystem make switching costly for clients as they are deeply integrated into the global semiconductor supply chain. It also benefits from operational efficiency due to its size. While intangible assets like patents add some protection, it's not unfeasible that competitors might innovate and surpass them. Overall, this earns Applied a moderate moat, significant but not unbreakable. Looking at the balance sheet, assets has grown steadily, reaching over $33 billion in 2025. Equity has risen faster than liabilities, with a 12% CAGR versus just 4.5% for debt. The debt-to-equity ratio has improved from 1.19 in 2022 to 0.77 now, indicating a healthier, less leveraged balance sheet. Overall, this is a very solid balance sheet, showing the company has healthy growth in assets while keeping debt well under control. Applied Materials essentially has no net debt, with cash in the bank slightly exceeding interest-bearing debt. This is amazing, and if they wanted to, they could pay back all its debts today. Alpha Spread put the bankruptcy probability at just 1%, rated very low, thanks to strong cash flow and a solid capital structure. Interest coverage is over 37, which is excellent. This means that the company's operating income is 30 times 7 higher than the current interest payments, giving it plenty of breathing room. The current buyback yield is about 2.22%, roughly in line with the 5-year average of 2.29%. Here's how dividends have evolved. After a pause from 2016 to 2017, dividends resumed in 2018 and have increased steadily, from $0.6 in 2018 to $1.6 in 2025. The 3-year MA trendline confirms consistent upward momentum. Looking at the green line, dividend growth has been impressive, with big jumps like 36% in 2018 and 24% in 2014, though the pace has slowed down to around 11% in 2025. Now, diving deeper into dividends, Applied Materials offers a current yield of 0.85% with a 5-year CAGR of 13%. Once again, this is solid growth. The payout ratio has crept up from 14% in 2023 to about 19% in Q2 2025, but this is still a solid ratio which leaves ample room for potential future increases. Importantly, Alpha Spread rates the dividend as very safe, with a score of 84, and my own grade is a thumbs up. Let's look at return ratios. The key metric here, return on capital, shows how efficiently both equity and debt funding is converted into profits. Applied Materials report an ROC of 44%. Even accounting for slight recent dips from the 2021-2022 peak of 46%, Applied is outperforming semiconductor peers whose ROC typically range from 30 to 35%. In short, it's at the top of its class in deploying capital to earn strong returns. Totality, scoring the company. Applied Materials scores an impressive 81 out of 100 across 5 different areas. Sales earned 56 points, supported by 10.3 revenue CAGR and 16% EPS CAGR. Efficiency maxes out at 100 thanks to those stellar return ratios. Debt is also rated 100 with a healthy DE of 0.77 and 2.5 years to repay debt via free cash flow. Payback score 69 due to steady share reduction and growing dividends. On the business model side, if you've seen my last video, you know how amazing the value proposition, the secular trends, the optionality, pricing power, and competitive advantages are. Along with the moderate economic moat, I grade their overall business a solid 79. Key pros include leadership in the wafer fab equipment market, secular semiconductor trends, and strong institutional ownership. The cons: pronounced cyclicality, geopolitical sensitivities, especially US-China trade, and the need for heavy research and development. Combined, these factors deliver an overall company score of 81. If you want to go deeper into Applied Materials, make sure to check out my other videos. In part 1, we look at the business model, analyst and management commentary, and what insiders are doing. Then in part 3, we run a full valuation, including DCF modeling and price targets.